Okay, we should be live. Hi Pablo, and thank you for watching. It's my pleasure to produce the videos. And we've got some questions already, that's good. Okay, 7 o'clock. So welcome everyone to the live Q&A. So it's the usual format where you ask questions and I answer, and it's unprepared, so you can ask anything you like and I'll do my best to answer, which is great, fun usually. So let's start with a bit of background. So we've just revamped one of our courses, so I'll be talking about that through the course of the evening for the next hour. So we've made it the bond course. So we also have reviews of US funds, which previously we just had UK funds. So if anyone's watching from the US, hopefully it should be more relevant to you as well. And yep, normal stuff like the power hours. So if you want a one-to-one like this with me, then you can do that via our website pensioncraft.com. And we have a whole bunch of courses on investment too. And if you want to support us, you can just pay $5 on Patreon, or if you pay $10, you get our Sunday evening call. You get access to the chat application Slack, and you also get previews of the videos that we produce for YouTube. So let me get started on the questions. I can see we have about 100 people on the line on the channel now. So if you do like this, please do like the stream, and also share if you like by your social media. I'd really appreciate it, because then other people will know we're live, and that'll be great for us. So someone is asking about the $25 trillion debt the US holds, and they want to understand how this works, particularly if it is a due date and when it has to be repaid. Okay, so let me just show you what it looks like, because you can actually download this from the Fred database. So let me show you my screen. And if you go to Fred, oh, wrong site. So Fred is the St. Louis Fed, and this is their website, and it provides all kinds of data about the US, financial data. And if you look up Fed balance sheet, you can actually get the latest. Every Wednesday they publish the size of the US balance sheet, and you can see that currently it's $6.7 trillion as of yesterday. So not quite 25, but still that is pretty chunky. So yeah, big debt. But the question I guess you're asking is, what's the consequence of having so much debt? Now, if it's a large chunk of that is US Treasuries. So if you buy a US Treasury, whether you're the Fed or whether you're you and I, you get repaid your principal on the maturity of the bond. Most US debt, most US government debt is fairly short dated, usually 10 years or less. So that means within 10 years, that's going to automatically disappear from the Fed's balance sheet, because the Fed will be repaid its $100 which it used to buy the bond. So that automatically disappears. The same is true of the mortgage-backed securities, which are also bonds. And the other thing to remember is that the loans which the Fed has made available to people on Main Street and elsewhere, that's also a loan which comes with a finite lifetime. So all of this eventually will come back to the Fed. So ultimately, the size of the Fed balance sheet will shrink. And usually that's their preferred way to shrink their balance sheet, which is simply not to reinvest the money that they get back as principal gets repaid. And that's what they were doing previously when it was about 4 trillion in size and they were slowly rolling off the balance sheet. What they didn't want to do was to sell trillions of dollars of debt into the US secondary treasury market, because that would have made yields spike upwards and it would have hurt the US economy. So that's how they shrink their balance sheet. They just wait. They don't have to do anything else. If they want to speed up the shrinking of the balance sheet, then they would have to sell assets. But because they have so much stuff, they could easily flood the liquidity of any market. So they try to avoid that if they can. So the exit plan is going to be interesting. It's going to be difficult. It's going to be quite challenging to shrink the balance sheet without flooding the secondary market for many of these assets. I hope that answers your question. Administración Lab Malaga. William says, love your channel, especially inflation and deflation videos. Do you think it's likely that most companies' share prices will go lower than the March 2020 lows? Yeah, I mean, I still think that's the case. The next video, which I'm about to publish this weekend, is about that very topic. So if you want to hear my views about that, you might have to wait until Saturday or Sunday. William. Ely River Blues says, I watched your bond bubble video from last year. In the current circumstances, how would you change your conclusions if making the video now? Should we still buy bonds or wait for a better entry point? Well, I mean, the question is why you're buying bonds. If you're buying bonds because you think equity is about to sell off, in other words, as a hedge, then equity is still well hedged by bonds. So that's still one reason, tick, to buy bonds. If you're buying bonds to diversify your portfolio away from equity, well, yeah, it still does that, right? Because equity and bonds have a low correlation, or if not a negative correlation in many cases. So that gets another tick. If you're buying bonds in order to make a huge capital gain, well, I'd put a cross by that one, because the capital gain is going to come from yield curves moving lower. Now, if there's a huge sell-off in equity, that's a potential gain, but it's never huge. We're talking about 5-10% upside for bonds if there's a big equity sell-off. So, yeah, I mean, if you are going to diversify, then yeah, I'd still have bonds. They still perform that function in your portfolio. Nothing's really changed. All that happened is that yields are lower. So I wouldn't say that bonds are in a particularly precarious position at the moment. I mean, if we get very high inflation, they could be. And if the equity markets suddenly rally again, then they could be. But even so, the losses you make with bonds are usually much smaller than the losses you make with equity. So a 10% loss for a 10-year government bond would be catastrophic. It would be huge. Whereas for an equity, that would be like a 2-week move. Okay. So, yeah, I think the conclusions of the video would be the same, which is that bonds still have a very important role in a portfolio. Okay. I better start speeding up because there are lots of questions. Okay. Thanks so much for putting this on, Gio says, and your great and prolific content. You're the boss. Thank you very much. Peter Callender says, hi Ramin, how will governments recoup all the money they're paying out when economies are in recession? Is this helicopter money or QE? Now, the difference between the government, which does fiscal policy, and the Fed and the central banks is that the central banks only lend money. They get it back. Whereas the government can actually hand out money. It's a grant. Ultimately, though, they have to pay that money back if they've funded it with treasuries. Now, the thing to remember is that the US currently has a very large fiscal deficit. It's spending much more than it earns. Part of that is because of the tax cuts. So as you remember, President Trump cut taxes, corporate taxes, in 2017, which gave a big bump to earnings for US corporates. But the drawback is that the US the US income from that tax revenue has fallen, obviously. And the slightly dodgy logic that there'll be greater activity because taxes are lower, well, that doesn't usually work. It just means lower income. So the deficit has increased. The cost of paying for the crisis bailouts is huge. So, yeah, I think the deficit is probably unsustainable as it is now. But hopefully there will be enough revenue growth because of GDP growth bouncing back to at least pay for some of it. So I think that that's the danger, that the next government that comes along is just as profligate with its money as the current one and doesn't try to shrink the US debt, because now we are getting into territory where you start to worry a little bit about US debt servicing if interest rates increase. But of course the Fed to some extent can control that and stop yields getting too high and stop the debt servicing costs from getting too high. So if yields were very high, then it would be a problem, but of course they're not. So at the moment it's affordable. So no panic at the moment in terms of servicing the debt. So ultimately governments have to grow their way out, to answer your question. And the US is probably in a reasonable position to do that because historically they've been good at maintaining growth. Hey, love your channel, especially inflation and deflation videos. How impactful will the oncoming recession be on share prices? How low can companies like KO, Apple and Starbucks go? Well, I think at the moment it's fair to say that equity markets are priced to absolute perfection. It's as if the crisis never happened. It's as if everything's fine. Valuations are higher than they were before the sell-off. The forward PE on the S&P 500 is 21. Before the sell-off it was 19. So people are willing to pay more for every dollar of profit than they were before the sell-off, which makes me think that that's not a reasonable valuation given the economic backdrop. So I think that we could easily see a fall to a multiple of 10. And given that the multiple is currently 20, yeah, that's a 50% fall. So yeah, I think there's a lot of downside risk at the moment. Equity markets are in a very precarious position with a very high valuation, a catastrophic economic backdrop. You know, it doesn't take a genius to work out that, you know, there's a lot of risk being long equity at the moment. Good evening from Nuno Taborda. Good evening, Nuno. Me and my friend are ready to buy a house as first-time buyers. We're looking at Tottenham in London, Crossrail 2, lovely. Based on everything going on, how would you enter the UK property market, if at all? If we are going to see a recession, that generally is negative for the equity market. So as usual, the problem's going to be how long this crisis lasts. Now, there is some pent-up demand. And the great thing about the UK property market is that it's very lacking in supply. There's very little supply of new houses, and that means that demand often outstrips supply, and that keeps prices up. So, I mean, that's a positive. Interest rates are going to stay low. That's a positive. All I'm worried about is growth. If we get a deep recession that's long-lasting, that's going to be a problem because people's incomes are lower. There's more uncertainty about the future. People are worried about losing their jobs, and banks are lending less as a multiple of your salary. So the credit lending criteria are getting stricter. So whereas previously it was easy to borrow money from the bank, or relatively easy, now it's getting much harder, and they're willing to lend less with a lower risk, so a lower loan to value. And that generally is a negative for the equity, for for the housing market. So would I be buying now? Well, maybe not. I don't think there's going to be catastrophe in the UK property market, but my guess would be that there'll be a weakening of the property market, at least in the short term, depending on how long this impact lasts. So if we do get a V-shaped recovery, then I wouldn't worry. But if you think it's going to be a U-shaped recovery, where we kind of have low growth for a while and then we slowly get back up to trend growth, that could be a problem. How much of a discount would you aim for when negotiating? Well, I'm actually selling at the moment, so buy at a premium is what I'd say, in case my house buyers are watching. Okay. Nick Salter says, I read a lot about this wall of money that's waiting on the sidelines pending a dip in the market. Isn't a likely future sell-off going to be quickly halted by all this available liquidity? I think that's assuming that people have the confidence to put their money in equity. I mean, people always talk about the wall of money, but I think the difficulty is that people aren't willing to take risk with their capital when they're scared. And people tend to hold back from the equity market when there's uncertainty about their future economically. So they're probably going to put more money into savings, into the form of cash, than they would into risky investments like property or like equity. So I don't really buy the wall of liquidity or wall of money argument. Raphael says, hello everyone. Hi Raphael. Smurfy says, do you know why the UK Vanguard only offer the FTSE Developed World UCITS ETF distributing version and not the FTSE Developed World UCITS ETF accumulating one? No, in a word, I've got no idea. Sorry. That's certainly true of some of their funds, like there was another one which is VEMT, which is their emerging market bond ETF. It only has an income version. So if you are, if you're not in drawdown, so if you're not retired, I'd rather have an accumulating version, but there wasn't one, which was annoying. Yeah. So I don't know why they don't do that. I assume it's because they thought there's no demand for it. So, hey, get in touch with them and tell them you want it, because that way at least they'll know. Nick London says, why has the FTSE not performed well compared to the US in the last 12 years? Yeah, I mean, the UK has underperformed the US, but so has every other country. Now, one of the reasons why the US has outperformed is partly because of its sector composition. It's been very good at growing earnings in the tech sector and biotech, for example. So if you look at the NASDAQ, that's been the best performing passive. If you find passive trackers, NASDAQ trackers have just been amazingly good at outperforming over the last decade. So everyone talks about Terry Smith's Fundsmith fund and how great it is. But if you'd have just bought the NASDAQ 100 tracker, it outperformed Terry for about a tenth of the cost. So yeah, I think the US is very good at growing tech. The sector tilt of the FTSE 100 is to be overweight energy and hugely underweight tech. So that sector composition hasn't been a good one over the last 10 years. Also, the US has been doing a huge amount of buybacks, whereas the UK hasn't. And perhaps that's one of the reasons why the US has outperformed. But the reason why US equity has had the money to buy back a company's own shares is because they've been successful. So it's not just because it's got buybacks, it's just that they've been very good at growing earnings, I'd say. UK companies haven't been as good at growing earnings. Or has any other country in the world, for that matter. Not as good as the US. Should I buy fresh coin now? I'm not a huge fan of cryptocurrency. So, I mean, personally, I like assets which generate an income, because then you can at least have a crack at valuing them in terms of their income generating ability. Whereas something which doesn't generate an income, like gold, like some, in fact, most cryptocurrencies, it's very hard to know what the fundamental value is and when you're paying too much. So I'm not the right person to ask about fresh coin or cryptocurrency. Alvaro, sorry. Andre says, thank you for your work. My pleasure, Andre. Are there any funds that specialize in holding companies with good balance sheets? Yes, many. So you'd be looking for a quality factor fund, and there are many of them out there. So just if you're a UK investor, go to justetf.com and look for equity funds, look for quality. In fact, hey, I could do it now. Let's just do it while I'm on the call. Let me share my screen. I'll move this little Ramin into the corner. It's a big Ramin at the moment. Right, so if we go to justetf.com. Now this is an incredible resource for finding ETFs. So whenever anyone asks the question, is there an ETF for something? This is always the first port of call. And if we look for equity strategy, then let's say we want quality. Should be quality. Here we go. So all of these funds are quality funds. And if we sort them by cost, this iShares Edge MSCI USA Quality Factor Fund only costs 0.2%, and it screens companies. If you want to see what it's doing, then just Google for the index. So let's look for the index, and we'll find the PDF file from MSCI, and it tells you exactly how it's constructed. So it includes larger mid-cap US stocks, so no small caps, and it captures the performance of quality growth stocks, and it finds stocks with high quality scores based on 3 variables: high return on equity, stable earnings growth, and low leverage. So leverage is something you particularly want to avoid at the moment, so that might be a good one to choose, I'd say. So yeah, that's probably the way I'd approach it.
Thumbs up, like.
Oh yes, yes. A little voice is telling me that if you could like this stream, then other people will know that you like it, and other people will be aware it exists. So if you could like it, and if you do like it, please do like it. And you can also share it via social media, so other people know we're streaming live. We'll be going for another 40 minutes, so it's probably worthwhile. Yeah, so back to the questions. So yeah, loads of quality funds that you can go for, Gio. Rachel C says, just want to say how helpful I found your videos after recently stumbling across your channel. Thank you. My pleasure, Rachel. I'm glad you find it useful. Zishan, who I believe I talked to earlier today, says gold performs better in times of uncertainty. How about silver? The current gold to silver ratio is around 115 versus the historical average of 75. Yeah, so silver has industrial uses. Gold has very little use at all, but it is shiny, and people like it when they're scared, right? So as a fear hedge, gold is very good. As an inflation hedge, not so good. Inflation-linked bonds are much better. But obviously in times when people are scared and economic growth is weak, then the industrial metals underperform, like silver, like copper, like aluminium. Gold outperforms because people are scared. They buy gold. So yeah, this is a period of uncertainty, and I suspect it's going to be uncertain for a while. Certainly for the next few months, possibly until quite a long way into next year. But we'll have to see what happens with the crisis in order to see how quickly it's going to abate. but fear for now, certainly. Yeah, it's going to be a good environment for gold. Also, real rates, so that's the rate on government bonds minus inflation, is very low. And that's what's toxic for gold. When those real rates go high, then gold tends to underperform. The reason being, if you can buy a treasury bond, which is almost risk-free and which gives you a 5% income, why would you buy gold, which isn't risk-free and provides no income? So that's why gold tends to suffer when real rates go high. And at the moment, real rates are very low. So that's good for gold. The only bad thing for gold at the moment, I think, is a strong dollar, because it's priced in dollars. So if the dollar's strong, that reduces the price of gold in dollars. Right. Lola Lifestyle, cool name. Hi, Ramin. In this current climate, would you recommend opening an S&P 500 ETF with Vanguard or a Vanguard Life Strategy 60% equity fund? Which is a better investment in your opinion? I can't say, because I can't say what your risk appetite is, Lola. If you are going to be investing for a long period of time, like 20 years, 30 years, if you're young, then, and you're willing to take a lot of risk, which young people generally are and should be, then yeah, I mean 100% equity is reasonable. But if you'll need that money in less than 10 years, then being 100% equity is very risky, because over periods of 10 years, you do get periods when equity markets fall. Whereas over a 30-year period, it's very unusual for equity markets to fall globally. So I would say if you need that money soon, i.e. less than a decade, or you're not young like me, then I'd go for the 60% equity, because it's also diversified globally and it's got 40% bonds in it, which tend to cushion falls. So yeah, it really depends on your lifestyle, your investment horizon. So if Lola's lifestyle is a risky lifestyle and Lola's going to be living for a long time, then go for more equity, probably. Sarath Babu Arava Bhumi says, hello Ramin, hope you're safe and well. Yes, thank you very much. Deepak Singh, intrinsic value calculation and investing after a margin of safety. Don't you think it's a better approach than passive index fund investment? No. Although having said that, I think having an idea about how valuation works is really important, because you can also value indices. I often look at the price to earnings value for the S&P, for example, the forward PE, the trailing PE, the CAPE. I think all of that applies at the macro level and at the index level. So I think intrinsic value is really important. I love it. I think it's very important to understand it. I mean, you don't want to buy equity when it's expensive. And if you have the ability to know when something's expensive, then you'd be silly not to use that information. Because you don't want to buy something when it's expensive, you want to buy it when it's cheap. So personally, I think passive index fund managed investment is better, because for most people, it gives them a better long-term outcome. Because if you look at something like the Spiva survey, what it shows is that many funds, about 80% or more, underperform over a decade relative to their benchmark net of fees. So even if there are outperforming funds, which there are, they're very difficult to find. And also, their persistence scorecard shows that the ones which do outperform don't tend to carry on outperforming for a long period of time, which makes identifying the good funds very, very difficult. So even if they did outperform, how would you find them? And why do 80% of them underperform? And why would you go with those odds? You know, those are the difficulties I have with the active fund story.
Patron.
Yes. So if you do enjoy our content and you'd like to see more of this, and you'd like to see me eat, and my dog's not here, but he needs to eat as well, then please do support us on Patreon. You can either support us at the $5 a month level, where you just get the previews of the videos, or you can support us at the $10 and you get access to this kind of call once every week. You get access to Slack. Let me just show you our Slack channel so you can see what it looks like. And
Chat with you on Slack.
yes, and you can chat with me or the other people on Slack, because increasingly I'd say the collective intelligence of the pension crafters is greater than the collective intelligence of me. So that's the benefit, I think, of having the community, which is kind of group intelligence and experience, because a large part of investing is experience. So let me show you what Slack looks like. So for example, this is the questions for the Q&A call. So these are the questions that we were voting on for the last Sunday's call, and you can see what we do is we number the questions. It's anonymous, and then people vote on it. So the one which won was number 7, about Warren Buffett, about buying just the S&P 500. What kind of strategy is that? Is it a good one or not? So that's the kind of thing which you can ask. We also have various different channels here for different topics, and so for example, if you've retired and you're talking about drawdown, you go for this channel, and we talk about stuff in the news all the time. So that's one of the things you get if you subscribe at the $10 a month level, and you also get the access to the Sunday calls and the previous backlog of Sunday calls. And we have notes that go with each call with lots of links in it, so you can follow it and research in more detail if a particular topic whets your appetite or is of interest to you. Okay, so here's my branded 7-Up, because I'm getting a bit thirsty. Okay, any comment on Berkshire Hathaway's recent AGM? Yeah, I mean, I watched it a couple of times. I really enjoyed it. It's always interesting to hear Warren Buffett speaking. It was interesting that he's not kind of very gung-ho this time. He's still very cautious, which normally when equity markets have sold off, he kind of says, oh, you know, loading my elephant gun, going to bring down some big game, you know, I'm going to buy some big companies. He's not saying that now, because I think equity markets aren't cheap, and I think it's just a reflection of that. So if there were many cheap companies out there, you bet he'd be buying, but he's not. So perhaps also, I don't know, maybe it's because the insurance company that he runs is likely to need some of the liquidity. Maybe that's another reason why he's being cautious. But 126 billion or so in US Treasuries is what he's holding on to at the moment. So big cash buffer, which he could invest if he needed to. So yeah, I really enjoyed it. I thought it was interesting. Yeah, it was a bit downbeat as well, and he had a bit of a haircut issue, because obviously he hadn't had a haircut for a while. But it was a bit weird not having the kind of audience there reacting to his comments, which he obviously enjoys usually. It's quite sad in a way to watch him kind of just drone his way through without the kind of audience feedback, which usually he has. And you can just feel the immense love of the audience for him, which is lovely to see. Okay. So yes, I watched it, loved it. Okay. Yeah. So, someone's saying, what legal disclaimers do you need to be able to run a finance YouTube channel and website? Do you have to use a solicitor to write a disclaimer? I did. That was the first money I spent, was to get a disclaimer written by a solicitor who specialised in, um, in such things. As long as you don't provide financial advice or financial promotions, as long as what you're providing is education, I think it's okay. Until it's not okay. I mean, it could be that in the future the law changes, but certainly for now, as long as you provide education rather than advice, which is what we do, then I don't think it's a legal issue. But I'm not a lawyer, so I'm not the right person to ask. Assets shown of Fed, loans due to the Fed. Assets is not a misnomer. The journal entry on the Fed's ledger is debit loans due, T-bonds, credit cash. We just printed out of thin air. Yeah. Yeah, I mean, that's how they fund it, right? Thin air cash, as you say. But the assets, yeah, I mean, it generates an income. And there's a real possibility that they'll generate a profit on the loans that they've made, which they have to give back to the Treasury, which is interesting. Mina says, thanks a lot for the content. Pleasure. 2 questions, please. What's your opinion on Vanguard active funds as global equity funds, and how to assess fund risk such as Sharpe ratio and Ulcer index, where to find them? Right, so yeah, Vanguard active funds, I like them because usually, I mean, Vanguard, if you go and talk to them, they always stress the fact that they're not passive. They're not a passive house. What they are is a value house. So they want to make sure you're not charged too much for a fund, whether it's active or passive. And they try to find the best fund managers. A lot of Bailey Gifford, I have to say, in the UK. So there are quite a few active funds they've got. And yeah, I mean, if you're into active fund management, certainly, you know, I think theirs are as good as anyone's, and cheaper, which is the important thing. Personally, I don't use them, except for the minimum volatility one, which is a factor fund, which is technically active. But it doesn't have an active fund manager deciding what to buy. It's more kind of algorithmic, as far as I know. So it's more a kind of computer program written by their quant team, mostly in New York or in the US. How to assess fund risk such as Sharpe ratio and Ulcer index. Well, the obvious stuff for a fund is, for your portfolio, is just how much equity it's got and which equity. Is it concentrated in one country, in which case you've got a concentration risk? Is it concentrated in one sector, in which case you're not very well diversified? So if you only bought tech stocks, that's concentration risk. If you only buy energy stocks, big concentration risk. So those are the things I'd usually look at. And then you can look at the portfolio volatility, which is one measure of risk. And if that's very high, then maybe consider putting something with a lower volatility or which is uncorrelated to your existing assets like treasuries or government bonds. Sharpe ratio is a good way to do it. So risk adjusted return. What return did you get divided by the risk you took to get it? So if you get 10% return by taking 5% risk, that's not as good as 10% return with 1% risk, right? Because the risk adjusted return would be higher. The Ulcer index is great. I love it. So that's the amount of time it takes after a drawdown when things sell off. It's a number of years it takes to get back up to its previous level. The idea being that you get ulcers during that period of time. And if you look at the portfoliocharts.com, let me just share that with you. It's got the Ulcer index. If you're not familiar with this, it's great. So here it is. So here are the charts, and let's choose a standard portfolio. Where are they? Yeah. So let's have a look at the standard portfolios. So it's got a whole bunch of the standard ones, like all seasons, say, and then for each of these, it gives you the performance. So the usual, so this is the allocation. And you can change the country if you want to another country. So you can do UK, Netherlands, Spain, whatever. And it gives you the distribution of returns. And it gives you the kind of Monte Carlo simulation to see how likely it is to reach a certain goal of return over some period of time, assuming the future resembles the past. And this is the ulcer index. So on average, it took about 3.6 years, I think that's what it means, to reach its previous peak. The longest it's ever taken was 10 years. And if we change it to some other portfolio, you get a different number there, and a whole bunch of cool statistics that you get with all of the portfolios. And you can create your own portfolio and try stuff out. It's just brilliant. I love it. So yeah, that's very good. If you want to look at the ulcer index, it's a great way to do it. Okay.
Likes.
Yes, please like the channel. That would be great. Like this video, rather, this stream, and then other people will know that you like it. That would be very helpful for us. Going to skip forward a bit because otherwise I'm going to get nowhere near to the end of the stream questions. So Raphael says, hello Ramin, what do you think about China prospects in the future? Buy US stocks or Chinese stocks? How would the Chinese yuan devaluation affect my Chinese stocks? Do you think that's probable? Thank you. Right, so I think one of the difficulties with investing in China is the transparency issue. So I think it's fair to say that corporate governance isn't as strictly monitored in China as it is in other markets, such as the US and Europe, for example. So I think that's an issue. How much can you trust the results, the corporate results which are published, the accounts of the companies? Because if you are, say, a value investor, you really do depend on those numbers. And if they're fraudulent, then, what can you do? But as a whole, I mean, if you buy a China A shares tracker, for example, do I think that's going to outperform global markets over the next 20 years? I think that's a real possibility, because I think the ability of China to grow earnings is greater than it would be for some developed markets. So I think that China certainly is probably going to outperform, and emerging markets will outperform over the next 20 years, if I had to choose. So if I was advising my children about what to invest in, I'd certainly have them consider emerging markets. But will it outperform hugely? Probably not. I think it's going to be a tough decade for all of us over the next decade. But yeah, I think that's important. Chinese devaluation would be a problem if you don't invest in renminbi yourself. I don't know if you're based in China yourself, Raphael. I'm guessing not. In which case, a devaluation would matter if you buy onshore A shares. If you buy offshore shares, so for example H shares, which are based in Hong Kong, then renminbi devaluation wouldn't be such an issue, right? But there'd still be an effect, because certainly when the renminbi devalues, it sometimes makes the Chinese equity market sell off. So that's certainly something that happens at the same time often. So, but I mean, if you're investing over the long term, then probably currency isn't going to be the most important thing you're worrying about. It'll be the equity market earnings and how well they perform relative to the other markets globally. Dave Kelly says, I notice you're using iShares when quoting examples in certain graphs and maybe not using Vanguard as much. Is there any reason for this? Not really. I think they just offer a wider range of funds, and sometimes if I want to talk about corporate bonds, for example, high yield ones like J&K, HYG, well, I can't use Vanguard because they haven't got one, or gold. Vanguard doesn't have a gold fund or a commodity fund. Plus, I don't have any kind of affiliation with Vanguard, so I think it's good to sometimes spread the ETF love a little bit with other providers. I'd say that's it. I mean, sometimes iShares is also cheaper, which is a biggie. I think that's probably more important. I've got no loyalty to a particular fund provider. Unfortunately, though, I'm forced to have loyalty to Vanguard because on their platform I can only buy their funds at the moment. Scott says, no chance this will be paid back. 2019 was a great tax collection year and the US federal government collected 3.5 trillion. They just gave out about 2 to 3 years of tax collections. Yeah, it's going to take a while. Eventually, I think they probably will make it back, but they've got control over their spending. So I think the next US government will probably have to cut back on spending. However they do that, I don't know. Or they have to raise tax, which isn't going to be popular. But somehow they have to balance the books and come up with a sustainable level of debt before rates can increase. Because if rates start to increase with an unsustainable debt pile, then your debt servicing costs become huge. So there is a kind of clock ticking to ensure that they balance their books. John says food prices are rising. Are you based in the UK, John? I don't know. Yeah, but I mean, generally, inflation in developed markets depends less on food prices and more on things like housing and leisure activities. Food is a less important part of the basket, the consumption basket. In developing markets, food is a much more important component of their consumption basket. So as far as inflation is concerned, I'd say food matters less in developed markets. It's going to be a Nike recovery. Oh, very good, a swoosh. I like that.
Navigating investment through a crisis.
Yes, we have a course which is called Investment Navigation Through a Crisis. It's £19.99 and it sort of talks through a lot of the issues that we've been discussing. I've done previous calls on this. So which assets can you buy in the crisis? Which sectors perform best? How long do crises last? Which assets have provided the best hedge? So many of the questions you might ask about investing through a crisis. And it's got some video in it. So four videos in it, which are exclusive to that course. And a big explanation of how to value equity. So all of this stuff that you might find useful for deciding when to buy equity as we go through this crisis.
In the description of the video.
Yeah, and there's a link to it in the description of this video, which you can see, hopefully. Yeah, so do like the video as well if you do like it. I'd appreciate it. Because we'll still be talking for 12 minutes. So time to show my 7-Up again. Mark Jones says, sold all assets, mainly house building shares, held since 2008. After possible next downturn, would you advise on buying them back, along with the Life Strategy Fund and investment trusts? Well, I think coming out of a crisis, once you know it's over, the stuff which is sold off the most generally rallies the most. Now, usually that's small caps. So small companies, maybe also emerging markets, maybe high yield. All of the stuff which is more risky generally gets depressed during a sell-off. But of course, we've seen a very big rally since the Fed announced that it was bailing everybody out. So, I mean, it's not looking cheap anymore, right? So unless we saw another fall, I wouldn't really be happy piling up on risk in this environment. Just stick with for most people, just stick with your long-term strategic goals. Make a plan, find an equity bond split you're happy with and stick with it. And just dollar cost average through all these crises, because that's probably going to get you a very good outcome over a long period of time. And trying to time markets, second guess what's going to happen, usually doesn't really help. Plus it comes with all sorts of cognitive biases which hurt your return. So probably not worth thinking about that unless you think you can time markets, and most people can't. So maybe dollar cost average. I assume, Mark, that you're still investing, in which case, you'll still be putting money back into the market. So yeah, I think probably we're going to see another sell-off, I think, but I don't know. Don't make forecasts, fortunately. But yeah, if you think that equity markets are going to sell off more, when you think they're cheap, then coming out of the crisis, housing stocks generally do well. House building does well. But the risk is that you time it too soon and you take a bit of a hit. But as long as you don't sell, not a problem, because they'll eventually recover. William says, what finance and investing books do you most recommend? Thank you. There are certain ones which are very close to our own philosophy, which are things like Lars Kroyer's book, Investing Demystified. I was just discussing that today. I don't like Benjamin Graham's I don't really like Benjamin Graham's books, to be honest. I find them very difficult to read and in a really weird, stilted style. I don't know if it's because it was written so long ago. But yeah, I don't think that's particularly useful. I love Irrational Exuberance by Robert Schiller. There's a very good book on pension drawdown by Abraham Okusunya, which is called Beyond the 4% Rule, which I love. That's very good. So yeah, there's a bunch of books out there. You'll find if you go to pensioncraft.com, there's a book list of books that we like. If you look in the learning menu, you'll see it there. So not a huge number of good books that I've found on investing, I have to say. Lola says, what's your opinion on free trade? They raised quite a lot this morning on their Crowdcube funding. They're certainly good at raising funding. I do like their kind of ethos, which is to, interact with their community, which is kind of what I'm doing now, I guess. They're very interactive. They listen to what their community says. They let their community decide which shares to add to their platform, and they act on what they say. They seem genuinely committed to keep prices low, to keep fees low, which I love. They do seem a little bit stock picky, if you know what I mean. They kind of peddle the concept that you can choose single stocks and outperform the market, which I don't like. I think that's not true. Most people can't choose stocks and outperform the market, and their platform makes it very easy to trade. So if it's 1 a.m. in the morning and you've been out drinking with your friends, well, you've still got your phone with you, and you could quite easily put some trades on, assuming you can still press the buttons. And that, trading isn't something you want to do after several pints of beer. So I think it makes trading a bit too easy, and it makes it feel more like a game when it really shouldn't be. In fact, trading infrequently is probably the greatest recipe for success that there is, I think. So I do like it. I like the ethos, but Yeah, gamifying trading is something that worries me. But their interface is great. It looks really good. I've never used it. I've just looked at it because I reviewed it, but I do like it. Your knowledge is awesome. Sweet one, geezer. Thank you very much, William. Which sectors do you think will be least impacted in the likely sell-off? Well, the ones which haven't been impacted so far, which are the defensives, so it would be consumer staples, which is the stuff you have to buy, food, and tech isn't affected by client-facing restrictions. Anything to do with hospitality and leisure, obviously, you probably want to keep away from. Energy, because the price of oil is still languishing at around $20 to $30 a barrel, 25. So yeah, I think it's pretty much the same as the sell-off we saw before because the drivers are the same. Scott says, one answer to why US has outperformed, see Fred graph, government dollar is propping up asset prices in USA. Yeah, although to be fair, many other central banks and governments are also propping up their asset prices. Maybe not in the same size as the US, but even so. Bran says he's read A Financial Bestiary. That's great news. I hope you enjoyed it. Or apologies if you didn't. Many people say they do find it useful. I should say A Financial Bestiary is more for professional investors. So people who want to work for investment banks or as a fund manager or maybe central banks. So for those people, I think A Financial Bestiary is very useful. But if you're just investing for your own account, then maybe it's too technical for that. Scott says earnings haven't been great last year. Yeah, and that's why I sold. So we had 4 successive quarters last year where earnings in the US were practically zero. They only went up 6% in Q4, and that's why I sold equity. And then, now we see an awful Q1, and probably Q2 will be even worse, almost certainly. Yeah, so earnings were awful in 2019, but equity markets continued to rally, which was very odd and not very good. So Nick says, thanks for the great answer, my pleasure. Paul Jones says, great channel and video. Are yield stocks an alternative defensive play to quality or low momentum strategy? Yield's a bit iffy at the moment because if you look at dividends, they've been cut very dramatically all across the world. So buybacks have slowed, dividends have been cut, and that means yields have fallen. Yeah. So I would say that I'd be cautious about that. The alternative is to go for something low risk, like minimum volatility, as I've done, or something like quality, which goes for companies which have low leverage, for example. That might be another way to be more cautious in your allocation. John Basic, thank you. You've asked a question you've paid for. So let me just thank you for that. And then the question is, the US Central Bank is set to enter the ETF market. In fact, it did yesterday. The Bank of Japan has been doing it for years. Any key dangers? How can I profit from this? Well, the simple answer is simply to buy what the Fed's buying. So treasuries, obviously, huge numbers of treasuries. They're going to buy $500 billion or more, $500 billion, I should say, $500 billion or more of US treasuries. And they're going to buy ETFs, which track investment grade primarily, but also fallen angels, which are high yield companies which used to be investment grade but got downgraded. And there's probably going to be a lot of fallen angels because half of IG investment grade was triple B, the bottom notch. And in a recession, as we're seeing now, you get a lot of transition. double notch downgrades or single notch down into junk. And those are called fallen angels. So as we kind of shake the credit tree with this revenue shot, a bit like a kind of, might be, one simple strategy. That's probably the best way to profit from it. But, there hasn't been a huge rally, I have to say, so far on the back of the Fed buying those ETFs. You could say that that's kind of priced in already, but we'll have to see how much they buy. If they buy a lot, then, there could be quite a bit of upside. So really it depends on how long they continue buying and what size they buy in. I mean, the Bank of Japan, for example, owns the vast majority of Japanese equity ETFs. I doubt the Fed will want to be in that position. They certainly set out very clear guidelines as to how much they can buy. So that's probably the simplest way to go about it. So thank you for your question, John, and thank you for paying for it. Is there a North American version of Just ETF site you just recommended? Yes, ETFDB is the one in the US. I actually pay for that. I just started paying for it last week. It's very good. So ETFDB is probably the one to go for in the US. And again, it answers the question. It's got a screener, so you can find an ETF to track any particular market. And being the US, you've got a much wider range of exchange-traded funds to choose from. So that's great. I've noticed the quality of the data as well tends to be better, I'd say, for ETFDB. Buffering. Oh dear. Okay. Apparently we're buffering. Let me just see if I can... Okay. Buffering. Refresh and it'll work again. Yes. Yeah, so free trade also offer a good selection of ETFs. You can broadly diversify on the platform with equity and bond ETFs. Yep, true. I mean, it does give you a broad selection. There's nothing to stop you from using free trade to invest in index trackers, but it also offers things like cryptocurrency and single stocks, which, I think are unlikely to give you an outcome which is as good as, or at least as safe as, a diversified index portfolio. Bern says the course is really worth it. Great content. Thank you, Bern. Very good. I'm glad you enjoyed it. Who is the other voice in the room? Ha ha. Is that you, Teddy? Oh no, it's Laura. Laura. My colleague Laura. Which ETF for third world exposure? Thanks for info. Well, Vanguard offers an EM equity fund. iShares offers one as well. Or you can go for single country exposure. So iShares offers single country EM funds. But I mean, if you just want global, a broad EM exposure, there are several fairly cheap funds which allow you to do that. Again, look on Just ETF or ETFDB for that. It's very easy to do.
Sell.
Yes. So I would say, yeah, I'll probably wind up pretty soon, I think, because we've had an hour. But let me just say, yeah, if you do want to join us, if you do want to support us, please do on Patreon for $5 if you don't want access to Slack, or $10 if you do want access to Slack and the Sunday evening calls. And yeah, the courses. Don't forget that we offer an investment navigation through a crisis and also a bond fund investment video, which is now adapted for US investors as well. So we review each of the categories of different types of fund, like inflation linked, high yield credit, investment grade, and treasuries and MBS. So I think that could be interesting if you're a US investor. You'll find that on our description below this video, how to access the courses. And you can always get a one-to-one with me. So you can speak to me one-to-one as we're talking now. And you'll find how to do that in the description as well. So thank you all for your time again. It's been great. Wonderful questions. I have to say the quality is always so good. Thank you very much. And hopefully we'll see you on PensionCraft, hopefully in future. If not, then in one of these live sessions. So thank you very much, everyone. Have a great week and see you again.